My name is Andrew Hallam. I'm the author of Millionaire Teacher and Millionaire Expat. Today I'm going to talk to you about the stock market. One of the things that people are most concerned and curious about is how the stock market has plummeted during the coronavirus issue. I thought today we could talk about a few important talking points. One of them would be about a vegetable oil scam. Second, about horrific soft drinks. And the third is about bad drivers. You may wonder how those three things relate to the stock market. Let me back up for a moment, and I'm going to talk about how those three things are connected. First of all, when we think about Warren Buffett, we think world's greatest stock picker. And now, one of Buffett's tenets has always been to try to find great businesses trading at a discount. Great businesses that have one-time huge solvable problems. Solvable problems affect revenue dramatically. When revenue is dramatically affected, dramatically reduced, it affects the price of those companies' shares. So take American Express, for example. It was one of Warren Buffett's best purchases. American Express's stock price was down 40%. Its revenue had dropped significantly. And one of the reasons its revenue had dropped so far, so fast, had to do with the fact that it had gotten into a bad loan where it borrowed or loaned money to a vegetable oil company that claimed it had loads of inventory. And what that vegetable oil company had done was it had filled barrels of what was considered vegetable oil with water. Said, hey, look, here's our inventory. Look how much vegetable oil we have. Because oil floats, people looked at those barrels and went, hey, there we go. We can see loads of oil. Anyway, so American Express approved the loan. It ended up being bogus in terms of the inventory. The company defaults on that, and American Express's stock absolutely gets tanked, and they lose a ton of the money that they borrowed. As Buffett saw it, that was a one-time solvable problem. You could take the example of Coca-Cola that he started buying shares of in 1986, 1987. And if you're old enough to remember, Coke, of course, had a time-tested, very popular product. It had it for decades, but it tweaked its product, and in 1987, it created New Coke. It thought, hey, we're losing the Pepsi challenge, where people were actually on television, Pepsi ads were saying, hey, here's the Pepsi challenge, try some Coke, try some Pepsi, what do you like best? Well, invariably, when you give people a small amount to drink, they prefer the sweeter drink. The Pepsi challenge was making Coke drinkers making Coke not look as great. But for many Coke drinkers, if you'd had them drink, or anyone, for example, you had them drink an entire Coke can, an entire Pepsi can, the sweetness starts to turn them off after a while. But Coca-Cola didn't recognize this. So they basically reshifted their drink. They added loads more sugar, and they created a different taste to it. And what ended up happening was hardcore Coca-Cola drinkers went, this stuff is horrible. They wanted the classic Coke to return. But what happened was, of course, people stopped buying Coca-Cola. Revenue started to decrease dramatically for Coca-Cola. Coke shares went on sale. Warren Buffett knew that it was a solvable problem. Coke introduced the classic Coke recipe. Things eventually started picking up, but not before Buffett was able to buy shares at a discount. The same thing occurred with Geico. You probably are very familiar with Geico as the insurance company that has that cute little gecko guy with the British accent, does all kinds of fun things to make us laugh. Geico's been around a really long time. Warren Buffett learned about Geico from Benjamin Graham, who was his mentor and professor at Columbia University. And Geico had very strict parameters in terms of who it would insure. Then Geico decided that they were going to loosen those parameters, and they were going to allow just about anybody to have insurance. It didn't matter what kind of track record they had or driving record they had. This cost Geico millions of dollars because, of course, claims were rolling in. Geico was having a tough time. But all Geico really needed to do was take the standards that they previously had, tighten them up, and it would bring the revenue back. But based on the fact that revenue was so stressed during this time period, much like a company or a store closing shop for a while, that might sound familiar to you, stock price crashed, Buffett came in and eventually bought the entire company. How and where does this connect with you? First of all, we have a massive stock market crash that's just occurred. So as I'm speaking, the US stock market is down for the year ending March 20th, or at least year to date, March 20th, 2020. The US stock market is down about 29%. That's a really big drop. It's lost almost a third of its value. This isn't unprecedented. This kind of drop has happened before. In fact, it's happened several times during my lifetime. Just to give you an example of the financial crisis, we had 2008, 2009, from peak in 2007 to trough in March 2009, the US stock market dropped 46%. So again, to put this into perspective, that was an extremely, as it is now, frightening time. So let me give this some kind of context. Lehman Brothers had declared bankruptcy. This is one of the biggest investment banks on the planet. The US banks were in serious troubles based on the subprime mortgage issue. And it was thought, widely thought, that the entire financial structure would completely collapse. We had the issue with the hedge fund long-term capital management as well. And if you want to look that up and see what happened to that and how that's connected to this whole mess, that in itself almost brought down the entire financial structure in the United States. The entire financial services industry nearly came to its knees. How does this relate? Think about this. If banks completely go out of business, now we're affecting businesses that are borrowing money from the banks, people are needing mortgages, people needing credit cards. We're really looking at financial Armageddon. And that's why Warren Buffett most recently said, compared to that and the fears, possible issues and ramifications, if we want to look at it from an economic perspective, the coronavirus issue, yes, is a big deal, but he says compared to that fear, it's not. Because what we have is we have loads of businesses globally with a one-time solvable problem. They don't necessarily need to change their business models either, like Coca-Cola had to do, or create a different product, or change things like Geico did with its insurance. They just have to carry on the way they've carried on, have this hiatus, but then the idea is that when people get healthier, when this virus issue is now out of the way, businesses should slowly start to open up again. And we're already seeing that in China. So once these businesses start opening up again, people then can obviously start feeding the businesses with their revenue. People can stay employed. The market has dropped about 29%. We've had really big drops before. But unlike the case of, say, a Warren Buffett, who's trying to find a marvelous business with a one-time solvable problem and get a discount, we have the entire global market on sale. So it's far easier to take advantage of market discounts. Unlike Buffett, in his case, if Coca-Cola ended up getting into trouble, or if American Express ended up getting into trouble, well, he's put quite a bit of money into that one, or into those respective companies. But if you're buying a global stock market index or a US stock market index, you're owning the entire market. Some of those companies might not survive, but those that do survive often end up thriving and end up purchasing components of the companies that didn't end up making it. All I'm saying here is you've mitigated your risk by purchasing an asset which gives you percentage of ownership of virtually every single share in what might be, if it's a global stock market, the global stock market index. If it's a US stock market index, you're purchasing a small fraction of virtually every share in the US stock market. When they eventually recover, you're going to make a lot of money. As a purchaser, discounts are the thing that you really want to be enjoying. It's a silver lining to this. Yes, this is an absolute mess. Yes, in terms of our health, it's extremely frightening. Yes, it's frightening in terms of employment prospects for people who aren't able to go to work and the stress that that might end up causing. But if you have a job, what we need to do is, if you have a job and you have a nice contingency fund, such that if you did get laid off, at least you have some money that would tide you over for a while. If you're adding to your stock market index funds, you're going to be buying or adding money at lower and lower prices. This is crucial because in doing so, you're really going to be doing what a collector would do. You should actually prefer sinking prices to rising prices. And I know that doesn't sound intuitive, but that's the case. If you're a net purchaser, you're like a collector, you should actually prefer sinking prices to rising prices. So this is the time to remain calm, carry on, take after your loved ones, keep clean, wash your hands, self-isolate. All of these things can also help to get the economy going. But the silver lining to all this really is you can capitalize on this long term if you remain calm and keep purchasing into the markets. Thanks very much. I hope this was helpful.